Tests are graded. They weren't too shabby. Some of you did very well. So cash flows is over. This part, because you are online, is not going to be as difficult as if you were in a classroom because you can use a cheat sheet. So this is going to be a quick chapter. Basically, we're going to cover the material today. You'll have homework due Wednesday night and a test on Friday. It's ratios. And the majority of the ratios that we're going to go over today, you've done in managerial. So they're not new. The ones that are different are hospitality specific ratios, which you've probably done in some of your other classes. So this should not be difficult. You got to know what the accounts are, but that's reflective of the balance sheets and things that we did earlier this semester. And so I'm going to start and I'm going to share my screen and then I'm going to come back in and share something else. So this is on Vanco Hall under chapter 5, and it has all of the ratios on it. The only thing is I made one little correction on it that you probably should do. It'll just make it easier for you. Is down here, if you print this off under operating ratios, RevPAR was not on there. So just insert that in there so that you remember what that is. So this is what I'm going to go by. Okay, this sheet. I'm kind of going to do them out of order because what I have is a spreadsheet that I use in managerial with the ratios on, and that's what we're going to go look at them, actually look at them. And then we'll do a couple problems from the book and then give you some homework, and that'll be it. So I have a lot of grading to do today. I've got to grade your projects that were due last night for you guys. And I got about 6 other things from my other classes. So that's what I get to do all day. So I'm going to stop this share. And I'm going to go to this spreadsheet. And I say this is the one of the ones that I use in managerial. So I may be skipping around a little bit. All right, so the first ratio that we're going to talk about is the current ratio. And current ratio compares current assets to current liabilities. And some of you on that cash flow test, just make sure you know what a current ratio is. It's all about the 1 year thing. So in this case, our current assets would be these first 4 accounts: cash, accounts receivable, inventory, and prepaids. So I'm just going to go through 16 because I don't think we'll have time to do both years. So this total right here is the total of these current assets. This total right here is the current ratio, compares your 2 current accounts. And you have current assets and you have current liabilities. So current assets, again, it's these 4 compared to current liabilities. Now, current liabilities in this case, with cash flow, we didn't include notes in the operating activities, but when we're doing ratios, if it's a current note, it's included. But in this case, the note we have is long-term. And so we are only going to include these 2 current liabilities, which is right here. And then we just divide. So what the current ratio is telling is that for every dollar we owe in a current liability, we have $1.01 to pay it off. Not a great liquidity situation. Hospitality industry, you can get away with a little bit less our numbers can be a little bit less than what if you were in manufacturing. And a big part of that is this inventory thing. So if you think about it, in the hospitality industry, your inventory better not be a very large number, because most of the time, if you have an inventory, you're talking about food. If you're in the manufacturing business, you actually have 3 inventory accounts. You have your materials that you're using to make whatever you're going to make. You have the stuff that you've made that's not finished. And then you have the stuff that is finished. So inventory is a large part of your current assets in the manufacturing business. And so they would require a higher current ratio. All right, so current ratio, current assets, current liabilities. If you have questions, again, as I'm going through, ask. Quick ratio uses current liabilities on the bottom, so that number stays the same, but we have to adjust the top number. And the quick ratio uses your current assets, but you do not include inventory or prepaids. So it'd only be your cash and your accounts receivable, because those are the things that quickly convert to cash. Sometimes it takes a while for us to sell our inventory. Prepaid expenses, that could be out for a year, depending on what it is. So quick ratio, same as the current ratio on the bottom, but the top, you can start with this current ratio and then just subtract off inventory and prepaids. Or think of it as cash and accounts receivable, whichever is easier to remember. And you can see right here, in a real world, we would want this to be at least a 1-to-1. And we certainly would want this one to be higher. Questions? Okay, on I go. So accounts receivable turnover. So basically what we're looking for, how quickly do we collect our accounts receivable? Okay. How quickly do we collect? So top number is accounts receivable. Okay, came right from there. Our bottom number, okay, our bottom number comes from down here. All right. So we have sales. No, let me take that back. Our top number is sales. So I want to know how quickly I collect my sales. So this is kind of a 2-step process up here. So sales is going to be on the top, but on the bottom, we have to average our accounts receivable. And that's what you can see I did right here. Took the accounts receivable for 16 plus the accounts receivable for 15. I added them together. See, I added them together and I divided by 2. If you look at my formula right up here, that's my average accounts receivable. That's what's divided into sales. So accounts receivable turnover. You're going to have several turnover ratios. With the turnover ratio, the bottom number is always the average of whatever the turnover is. So if it's accounts receivable turnover, the bottom number is your average accounts receivable. Most of the turnover ratios have sales on the top. Not all of them, you'll see in a minute. So if I divide, I get 12.23. So that tells me approximately 12 times a year, I collect my accounts receivable. Important to know when your money's coming in. This next one right here, this days to collect, goes right with that. 365 always. And then it's divided by whatever you just found. And that actually converts it to days. Make sure these two answers make sense. Kind of estimate in your head how many days it would be based on that. And then make sure that that comes out that way. All right, questions on the first four. Those are your liquidity ratios.
Do you ever need to worry about leap year? You said
Yes.
that number's always 365.
No, you do need to worry about leap year.
Okay.
All right, so leap year. Any year that is divisible by 4 is a leap year, and you're going to have an extra day. You got to watch that. Okay, you got to watch that. I'm not, this problem right here, I did not do that. So honestly, for the days to collect and these days to pay down here, actually we're going to do some of these, but always use 365, where the 366 will come in when we're doing some occupancy ratios. For this, just always use 365. All right, I'm not going to be doing all the ratios that are on here because some of these we don't do in this class. Okay, I'm going on. Inventory turnover. So same thing as accounts receivable. How long do I keep my inventory? And this one is really going to be industry specific. Hospitality industry, you better not be keeping that stuff very long because again, it's probably food. The difference between the accounts receivable turnover and the inventory turnover is that the inventory turnover uses cost of goods sold on the top. And that should make sense because inventory has to do with cost of goods sold. Accounts receivable has to do with sales. So if I go down here, there's my cost of goods sold, the 7055. And I have that right there. Because on the bottom, I again have to average my inventory. So there's my two inventory numbers. So right here, add them together. It's my formula. Divide by 2, get the average. And then that's divided into cost of goods sold. So in this case, our inventory is only turned over 6 times a year. So approximately every 2 months. And that's exactly what you get when you convert it to days. Okay, exactly what you get when you convert it to days. So this is hopefully not a hospitality industry. Okay, it's probably going to be something that makes equipment that takes a while to make. And so you don't have a quick turnover just because of the time period it takes to make whatever your product is. And again, very industry specific. You are talking about any type of electronics. You know, think about computers. They design it today, it's obsolete tomorrow. You would again expect fast turnover in that type of industry. With hospitality, you would expect that to be at least 12 times a year, so that you're turning over your inventory at least once a month, probably more. All right, so payable turnover you don't have to worry about, okay? That one is a... All right, let's see what else we have here that we can use. Asset turnover, that is the next one on your sheet. And same thing. With your asset turnover, it's going to be sales on the top, average total assets on the bottom. There's my two asset numbers. Add them together and divide by 2, which is exactly what happened right there. That is divided into sales, and we get 0.87. Now, Do we actually sell our assets and then get new ones every year? Absolutely not. So what this is, it's a measure of efficiency. These ratios, managers are going to keep track of these ratios, and they're going to see how they change from year to year to year. Some of them you want to see go up. Some of them you want to see go down, depending on what they are. You can also compare your ratios to the industry. There's a number of companies that will gather information from companies, categorize them according to industry, location, size, and do averages. And so then you can compare what you have to what the industry and a like business is doing to see how you're doing in comparison. What's next on yours? Okay. All right, so the next one's on there. We're going to skip down to profitability margin ratios on that sheet. And we're going to look at profit margin. Because the next ones are all specific to the hospitality industry, so we'll come back to those. And we'll do those with some stuff that's in your book. Okay, profit margin, net income to sales. So it's just net income to sales. Pretty simple. It's a percent. Okay. So every dollar that they're going to earn in sales, 19.33% of it will be profit. That's pretty good. That's darn good. And so the reason you have to look at all these different ratios is because if I look at that one, and that's the only one I look at, they're doing great. But if I go up here, they're not. So this is a typical situation where they have a great net income, but they have no cash. Okay? Look at their cash. Look at their ability to pay their bills. Okay? Here. Accounts receivable turnover. That's not bad. You would expect at least once a month. Most businesses, if they don't get once a month, they're going to charge finance fees. They will expect different businesses, depending on who they're dealing with, clients, customers. Sometimes they have different terms. Sometimes they're required to pay within 15 days because they're a little iffy and you're not sure about them. That all goes into you putting together your terms for your sales. And these are things that you want to watch. And so my point was, I did have one. You need to look at the whole gamut of ratios because they look at different things. And you want all of them to be healthy. Okay, you want all of them to be healthy. Depending on the industry, this days on hand with your inventory, that could be a serious issue. People don't want to buy old stuff. Okay, they want to buy the new stuff that's come out. And again, depending on what type of industry they're in, that could be an issue. Okay, let's go back down here. So, profit margin, they have a great profit margin. Every dollar in the future that they make in sales, 19% of its 19 cents will be profit. Return on assets. Okay, so you have a couple return ons right here. Okay, you have a couple return ons. The return ons, the top number is always net income. Bottom number, average of whatever the return on is on. In this first one, the return is on your total assets. Well, I already found what the average was up here, so I don't have to do it again. So I'm going to take my net income and I'm going to divide it by my average total assets. And so that's the percentage being earned on the assets. Again, that's pretty good. 16%, almost 17% return on an investment. And that's again down here, return on equity. Now with the equity one, you have to be careful because lots of times it doesn't give you a subtotal. So we have to add all these equity accounts together and then divide it by 2. So this 13.768, that's this. These two added together, it's right here. And then with my formula again, you'll see add them together and divide by 2. And then divide that into your net income. Okay, so an investment in this company, that's a pretty good return if you own stock in that company. The only thing that's come out that's been questionable is that liquidity portion, their ability to pay their bills. Everything else so far has looked pretty good. So we're just return ons, always net income on the top, average or whatever the return on is on the bottom. Turnover ratios. Inventory has cost of goods sold on the top. All the other ones have sales on the top. Okay, down here, we're going to continue on earnings per share. All right, so how much is the company earning per share? Not what they're paying in dividends, but what are they earning? Net income, number of shares. Down here, they tell you the number of shares. So all you're doing is dividing. Earnings per share, net income, shares. So that's our earnings per share. Now this one is nice because if you're looking at different stocks, this is one of the things that they always calculate. You can compare different companies. And it doesn't matter what the company's, the size of it is, because it all comes down to the number of shares outstanding divided into the net income. And so if you're looking to purchase some stock, that's one of the things you're going to want to look at. This next one is also something that you would want to look at. This takes the earning per share on the bottom and now divides it into the price. Okay, so the market price of your stock. So the market price of our stock, oh, why that's there. We look over there, was $48. And you're going to divide it by your earnings per share. Just make sure that that's right. Okay. This one again now brings in the price that it would cost you to buy that stock. Okay, stock selling for $48. Again, you can use this to compare stocks. Now it brings in the market price. What would you have to pay? What is that based on what the company is earning per share? Okay, you don't have to worry about these next two. Okay, so scroll back up. All right, let me add one down here. Okay, so I'm going to go down to the solvencies ones and we'll add some stuff here. So the solvency ratio is total assets to total liabilities. Total assets, easy peasy number to find, right? Right there. I'm going to do for 16. All right. So do you remember on that balance sheet, which I kept harping on you to do your total liabilities? This is why I need it for this ratio. If this balance sheet was done so that I had the total, I wouldn't have to go add them up. Now I got to go add them up. So I want all my liabilities. So I'm going to take the sum of these three: accounts payable, income tax payable, and notes payable. Okay. So there's my total liabilities, and then you just divide. Okay, so basically with my assets are about twice as much as my liabilities. Okay, twice as much as my liabilities. So my assets were basically financed half by my liabilities and half by my equity, the common stock and the retained earnings, just based on this. Since it's 2, that means that this is about half of this. So that's your solvency. The next one is your debt to equity ratio. Again, it would be nice if we had subtotals for our debt, subtotals for our equity. It's all about how the balance sheet is set up. But you can see that that's the same number. Debt on the top, equity on the bottom, which again would be just these two. And one common error, retained earnings is part of your equity. Don't forget that. And so this is a division. And so we get 87.36%. And so that should not be a surprising number because we knew that this was about half. So we knew that this should come in about 100% because they're very close. Okay, just showing you the portion of debt comparing to debt, which is used to finance your assets, to equity, which is used to finance your assets. Okay. All right, we have number of times interest earned. Okay, that one's right here. So this one's a little tricky. Okay, this one is a little tricky, and it all depends on how your income statement is set up. And this is EBIT on the top, which is your earnings before interest and taxes. What I suggest you do with this one is that your top number, and this is the way it is on your sheet, is your net income plus interest plus taxes. And then you don't have to worry about how your income statement is set up. This one is set up properly. Operating income is your EBIT, and that's your top number. But you would have gotten the same thing if you had added this and this and this. Okay, so it's just however you want to remember it. And then it's divided by interest. So this one, creditors are going to look at. Not only do they want to look at your current and your ability to pay your bills, they'll look at the number of times you cover your interest payments. And so this one is pretty good. Okay, this one's pretty good. But you also can look over here and see that they don't have a ton of debt. Okay, they don't have a ton of debt. And obviously from here to here, they acquired another 1,000, but the interest isn't that bad. The next one that is on there is your fixed charges. So it's exactly this one, except that you would add fixed charges to top and bottom. And a fixed charge would be something like, say, a lease payment on a piece of equipment. If the equipment in your restaurant is pretty huge, costs a lot of money, you might have a situation where you're actually leasing it to buy it, because you can't afford to just go out and buy it. Well, if you don't make that lease payment, they're going to come take that equipment away. And so you want to make sure that you have coverage of that lease payment. And so you would just add that to top and bottom and get the number of times that you have covered that. Okay, so I think the only ones that are left are some ones that we need to go look at using some stuff in your book because they're hospitality specific. Do you have any questions on any of these? Are you all asleep right now?
I don't have any questions yet, but if I have any, I'll probably email you.
That would be fine. This is pretty boring. I will be the first to admit that, but it's really important. If you go to a bank to borrow money or to a creditor, one of the first things they're going to do is they're going to take your financial statements and put it in a program that they have and figure out all your ratios, because they're going to have standards. That debt to equity ratio, that solvency ratio, they're going to have percentages in there. They're going to have standards, and they're not going to go above those standards. If your percentages are too high or too low in some of these things, with that one, they would have a hard time getting a loan because their cash position, their liquidity position is so poor. I mean, they can hardly pay the bills that they have. Go ahead.
So, like, if your ratios are too low, they won't give you loans because of that?
It depends on which ones they are. But those first ones that we looked at, that current ratio and that quick ratio, that's the company's ability to pay their bills. They can just barely pay what's due in the next 12 months. So to add another loan payment on top of that, that would put them underneath the ability of a 1-for-1 match. So it just depends on what it is. As far as low versus high, you got to look at all of them individually.
Especially because of how much manipulation can be done with things that don't have anything to do with the day-to-day operations of a business.
Yep.
Like when I was doing research on my company, a whole lot had to do with income tax paid because of the differences in tax law that happened. They went from getting a $2 million credit to having to pay $2 million. So that $4 million swing had nothing to do with their day-to-day operation, was all due to a tax law change, which would be shown in some of these ratios, and why also the topic of stock buybacks become a big deal with some of these numbers.
Okay, anything else before I go switcheroo? Okay, so the next ones I want to do, get your books out, and I can show you a bunch of these. On page 282. And we're gonna look at problem number 6. So let me get back out here. Let me just get onto a spreadsheet. All right. So these have to do with your activity ratios and operating ratios. These are very specific to the hospitality industry. So, number 6, we have 2 months. Now, this is, I gotta come back in for this one. This is where you need to know the number of the days in the months. You might think that's silly, but you would be surprised. So this is where I always teach the knuckle thing. All right, I'm gonna put my hand up here. So you start on a knuckle, that's January, and then you go in, that's February. Knuckle is March, in is April, knuckle is May, in is June. You double tap, July and August, come back. In is September, knuckle is October, in is November, knuckle is December. Any of the knuckles have 31. The ins are all 30, with the exception of February. Have you ever seen the knuckle thing?
I can't say I have.
Yeah, no, I don't think I've ever.
But does it make sense?
No, it makes sense. I just never
Absolutely.
seen it before.
All right, well, that will help you get your days, because that you're gonna need those when you do these next ratios. There's also the little ditty, 30 days has September, April, June, and November.
I always get messed up on that.
All right, so let's do knuckles.
I was taught the knuckles for a company that did not have monthly reporting. They were the alternate month ending, so it was the 4-5-4-5 kind of process for how many weeks. So you just gave me a flashback.
Not a good one, right?
I very much prefer monthly reporting. So
Yes, yeah, I would totally agree. All right, so let's get back here. All right, so let me just,
You said problem number 6?
yes, ma'am, 282.
Oh, say that one more time. I'm sorry.
All right, so we have single. And double. And these are our sales. And paid guests. All right. Okay, minus a few spelling issues. I hate typing on a laptop. Okay, here's what we have. So this is for May. This is for June. So these are the single rooms sold, double rooms sold, dollar amount of sales, number of guests. Okay. It also tells you in that first little sentence, and that is very, very, very important, is that the hotel has 100 rooms. Okay, that's important. You got to know what you have to sell. All right, so the first thing we're going to do, we're going to do these for both months. Okay, we're going to do these for both months, for May and for June. Okay, paid occupancy. I want to know what the paid occupancy percentage is. All right, so if I look at May, what is the number of rooms that I sold?
2,600.
2,600, right? It's these two added together. Everybody okay with that?
Yep.
Okay. So if I want to know the paid occupancy percentage, I want to compare my rooms sold to my rooms available for the same period of time. Does that make sense? Okay, this is what I sold in May. Okay, that's what I sold in May. And now I have to figure out how many rooms did I have to sell in May. How would you find that? How many rooms do we have to sell?
Could you divide it by 100 or something?
Okay, not divide, you're on the right track. But if I have 100 rooms every day, right? I have 100 rooms every day
Sell 100 times 31.
times your 31 days for May. This is where knowing the number of days in a month comes in. So that is, and I'm going to put it down here for you. 100 rooms times 31 days. Questions on that? Okay, so now just divide them. So what do you get? It's a percentage.
84%.
Don't round so much. Go out two more places.
Oh, that was 83.8 or 0.838.
Oh my goodness gracious. Hold on, I gotta get rid of this stupid little thing. Okay, I always keep them out a couple places beyond the decimal because sometimes that's the only difference. Okay. Now do the same thing for June. Go ahead and do it. I'm gonna let you do it. Do it for June. Same thing for June. Okay, what do you have for top number? We gotta hurry here. We only have 5 more minutes. Would be these two added together, right?
2560.
Okay. And then your bottom number would be what?
3,000.
Okay, because now it's gonna be 30 rooms, 30 days times the 100 rooms, right? Because June only has 30 days. So what is your
85.33.
Okay, ready, all right? So the key there is the rooms. Okay, the key there is the rooms. Okay. Now we're gonna do ADR. Okay, ADR, average daily rate. Okay, average daily rate. So if it's my average daily rate, it's based on what I actually sold. Okay, average daily rate based on what I actually sold. So it's going to be sales on the top, and it's going to be rooms sold on the bottom. Rooms sold on the bottom. And so this is what I'm actually earning based on what I sold. So what do you got?
$85.
Okay. So that's for May. And then for June, we're going to do the same thing. June sales.
It'll be 87.
Okay. Divided by that. Okay. So that's based on what you actually sold. RevPAR is based on what you could sell. And for some reason, you guys get these mixed up. So be careful. Average daily rate. So try to think of it. If it's average, it's actual. Put your A's together, kind of as a way to remember. Top number is still sales, but your bottom number is now based on what you could sell. And the other thing to remember is that RevPAR is always less than ADR, because that's based on 100% of sales. Okay, so this is based on what you did sell. This is based on if you sold 100% of your rooms. And that's the difference between the two. So just try to remember that RevPAR should always be less because it's based on 100%. And you don't ever sell 100% of your rooms. Okay, and don't worry about number 4 for there. I'm not gonna do that. Okay, so there's a couple that I didn't cover, but so most of them are the same exact thing as if it was a restaurant. So then it's just based on seat covers. Okay, exact same thing, except it's not based on rooms, it's based on seat. Okay, so you can find your seat turnovers. And then you can find this. And then under operating ratios, number 5 and 6, we did that when we were talking about income statements. Taking the cost of goods sold divided by sales just to see what the percentages were. So I think I got through all of them. All right, so here are your homework assignments. Yes, the word is assignments. So and I'm going to add to some of these too. Okay, so hang on a second. Let me just make sure I'm giving you the right stuff. So on page starting on page 290, number 19. Okay, number 19. Do not do F. Okay, do not do F. You can do everything else. Number 20. Okay, so number 20, scratch off 9 and 10. And then add inventory turnover and solvency. So inventory turnover always goes with days, and then solvency, and then take off 9 and 10. And remember, you're just doing ratios. It might seem like I'm giving you a ton of homework, but you're just doing a ratio. And then 21, for under number 1, don't do D. And number 2, don't do A. And then 24, just do the first 3. That's exactly like number 6 that we just did.
I'm sorry, 21 was number 1, A through C.
Correct.
And what was number 22?
No, in number 2 on 21 was B through F.
2, B to F.
And then 24, 1, 2, 3. Okay, so get those done. We'll spend Wednesday going over those. And then Wednesday night, you'll have a homework assignment, which you can actually see on Vanco. If you want to get ahead on that homework assignment, make sure you read what's on Vanco. Because I added a whole bunch of ratios to that. So you do to number 15. But that's not due until end of the week. So get these done for Wednesday. And then we'll go from there. I have to have midterm grades done by Wednesday. So it'll just be based on the points that we have so far. But I have to grade your projects that were due last night. So, and then the quiz for this week probably will not be included in there. Okay, questions?
No, ma'am.
Oh,
Okay,
thank you.
I will see you on Wednesday and I'll get this uploaded to Venko.
Thank you.
Great. Have a good day. Thanks.
Thank you. Have a good one.
You